And welcome back to the Financially Simple Experience. It is a new year. And with a new year, many of us start thinking about how are we going to manage our finances differently this year than we did in times past. I often say last year, but last year was quite frustrating for so many people. Now, I did notice that so many people last year changed their finances dramatically. In fact, I just read a report by Fidelity that showed that Americans right now are sitting on more cash than we have in recent history. We have a ton of cash, and so perhaps that's one benefit that came out of the apocalyptic year 2020. But nonetheless, as we go into January every year, we start making resolutions, New Year resolutions, and oftentimes finances are at the top of that list. For whatever reason, we start thinking more about finances in January. And coincidentally, at the same time, every year we get an influx of prospective clients who say, hey, I need help. I need help. You know, it's been said, in order to affect the future, you must disturb the present. People realize, look, I'm not going down the right path, and I don't know how to get to where I want to be. I read an interesting quote the other day that said, most people don't want to fail. They just don't know how to succeed. Perhaps you find yourself saying, man, my finances could be so much better this year. Hey, reach out to the team. It's a great opportunity, and we can help you. We get a lot of inquiries at this time of the year where people say, we need help, and we love seeing the radical change that can come through comprehensive planning. As we begin comprehensive planning for clients, after a short period of time, we start implementing changes and recommendations, and we start moving their finances into an efficient manner. We'll often hear clients ask a question. They'll say, how am I doing? I got to tell you, I get this question about weekly now, and I always answer it the same way. Now, whenever the client says, how are we doing, them ultimately trying to figure out how they're doing in relation to their goals or to their peers, or if they're a dentist, how are they doing in relation to other dentists? If they're a ditch digger, as one of my clients is, how are they doing in relation to other ditch diggers? Whatever it is, right? We want to also know how we're doing in relationship to others or our goals. Whenever this question is asked, how am I doing? Inevitably, I always respond, why does it matter how you're doing in relation to your peers? We can judge you against yourself. We can judge you against yourself. And this is where the income savings rate, or the annual income savings rate, comes into being. I was reading a book over the Christmas break called The Dream Manager by Matthew Kelly. It's a really interesting book. It actually talks about the value of working with a planner. I didn't expect that, but it was very interesting nonetheless. And Matthew Kelly recounts a famous quote that I've heard many times by Mark Twain, but then he adjusted it slightly. Mark Twain, as he said, wrote, those who don't read great books are at no advantage over those who cannot read, which is so true. How many of us can read, but we don't? Friends, you might as well be illiterate. If you're not reading great books, you might as well be illiterate. You've got a talent that you're not using. This is what Mark Twain was speaking toward. But Matthew Kelly modified the statement. I never thought about this. Matthew Kelly wrote, those who don't manage their money well are no better off than those who do not have money to manage. It's often been said, it doesn't matter how much we make, it's how much we save, how much we keep. And so that's where we talk about the savings percentage, the savings calculation. If we want to find out how successful we are with managing money or how we're doing, we can start with this one simple calculation. And we're going to use this simple calculation to grow into a more complex calculation that'll really hit you like right between the eyes. I'm telling you, whenever I did the calculation for myself, it was like, holy cow. And it became a realization to me that I needed to make some adjustments in my life. There's a story in the Bible. It's an ancient parable that's written in the book of Matthew, but it's also written in other ancient writings of some sort of a rendition of this parable. It talks about a master who was going to go away for a while, and he had 3 servants, and he wanted to entrust these servants with his resources, some money. So he gave one servant 5 talents. He didn't have U.S. dollars, so they gave talents at that point, as the parable goes. He gave one servant 5 talents. He gave another 2 talents, and he gave the third servant 1 talent, an actual dollar, an actual currency. And after a period of time, the time came when the master came back from his trip, returned, and he wanted the servants to give an account of what they had done with the resources that he entrusted to them. And The servants he gave 5 talents and 2 talents to, each used those resources and provided an increase in value because of the way they managed that particular money. They managed the money well. And the master said to them, well done, you're a good and faithful servant. You've been faithful in this small thing. I'm going to give you a lot of things to be faithful in now. And he rewarded them. But the third servant didn't take that approach. The third servant was scared of the master. He actually took his talent and buried it in the ground, took that currency and put it in the ground. And the master's like, dude, you could have actually put it in the bank and I could have got a little interest off this. You did nothing. Because of this, he was punished. And because he did not work to increase that which was he entrusted. I'm amazed at the sheer number of people in our society who will take the income, unbelievable incomes, and blow it. Have very little, if nothing, to prove that they've been given some money of resources to be entrusted with. We have individuals that come to us, desperate need of help, waving a white flag, and we get in their finances. We realize they make $200, $300, $700, $900, $1 million plus a year in income, but they're broke. They have no assets. They literally are working hand to mouth. And if they cannot work for a 30, 60, 90-day period of time, they're broke. They're bankrupt. We actually almost experienced this with so many individuals who called us for help in the COVID situation. Imagine had the PPP loan not come through. I had one client say, are we really that bad of business managers that we can't survive 90 days without income? The answer was yes. I know many people who come to us waving the flag saying, help us. We realize we're in this trouble and we want to get out of this. I even have family members who make lots of money, but yet they blow lots of money. They have very little to show for it. It's a common occurrence. It's an instant gratification. So let's do a self-assessment. Let's see how you measure up. By the way, this is the easy part. Next episode is going to get real. I mean, it's going to be like a fist hit us between the eyes. It is going to get real next episode. In fact, once I'd calculated my annual savings rate and my lifetime annual savings results, my life and my mentality changed drastically. So let's do a self-assessment. Let's see how we measure up to ourselves. So how do we calculate the lifetime, the income savings rate? Let's say that for the calendar year 2020, that you made $100,000 in income. Now, before I jump into that illustration, you got to understand this is where normalization of our income comes into play for us business owners. Yeah, you may only get taxed on $100,000, but you're paying your cell phone through the company. You're paying your vehicle through the company. You're paying your health insurance through the company. Your kids are getting paid. You're having company match on retirement accounts. You have all these other incomes that are going into the company. You've got to include that as part of your gross income, not whatever you're taxed on. Oh, see? So now if we're making $100,000 on paper and we've got $50,000 in benefits that we're benefiting from through the business, then our income is really $150,000. That's my first challenge to you. Well, I've spoken about normalization of our income for years now. We've talked about it on several episodes. Go and normalize your income. What is your true income? So let's make the assumption for round numbers now, back on statement, that you have $100,000. That's a number that we can all kind of do math in our heads as we're driving down the road, as we're in the boat fishing, as one person told me. Another person told me, they're like, dude, first thing I get up in the morning when I take a shower, I listen to your episode. I'm like, that is crazy. He goes, yeah, it wakes me up. I'm like, man, it put me to sleep. So let's assume that you make $100,000, right? If you make $100,000, what percentage did you invest into something that will appreciate in value? How much did you appreciate in value? So let's keep it super simple and then we'll compound and build upon it. Let's say that you earned $100,000 and you put $5,000 into a savings account or an IRA. Whatever, doesn't matter. You're putting it back and it's going to grow at some rate. That means that you would have a 5% savings rate. You made $100,000, you put $5,000 back, 5%. You're like, dude, that's nothing. Well, you'd be surprised at how many people don't even do that. Think about it. If you're making $1 million, are you saving $50,000 a year? Probably not. Statistically not, but perhaps you are. So now as our lives become more complicated, as so many of our lives are, we have to actually make a little additional adjustments. So now let's include, what is our actual principal payment on our house? Not the interest. You say, well, Justin, I pay $2,000 a month for a mortgage. That's cool. That's going to be PITI all included. What is your actual principal portion? So out of that $2,000 a month, maybe $500 a month goes into your principal. Thus, we would have roughly $6,000. So $5,000 a month times 12 is $6,000. I'm sorry, $500 a month times 12 is $6,000. $6,000 of our $100,000 is another 6%. Okay, so now we're up to 11%. Remember, we put 5% back in our IRA. Now we're putting 6% toward our house. We have an 11% income savings rate.
Owning a business is one of the most difficult things we can do. At some point, we've all considered hanging up and selling, but is the saleable value of your business what you think it is? Heritage Business Advisors can help you to maximize your business's value through targeted value growth and exit planning. To learn more, visit heritagebusinessadvisors.com.
You've got to look at your investment accounts, all investment accounts. You've got to look at the principal portion payments of your investment properties. You've got to look at capital improvement into assets, but only at a fair market value. What do I mean? It's not uncommon for individuals like myself to take dollars and redeploy them back into our business or into a hard asset, i.e. a piece of land, a improvement on a rental property, etc. But just because we spend, let's say, $50,000 putting a new roof on or building a new kitchen out, doesn't mean we're going to directly receive the results of that $50,000. So we need to know the actual fair market value of our capital improvements in a calendar year. We're going to have principal payment reductions in debt. And theoretically, you could take some dollars and reinvest them into your business for valuation improvement. So as you look at your cash flow scenario, you got paid $100,000 or whatever your number is. How much did you actually redeploy into assets which appreciate in value at a fair market value? So maybe you say, Justin, I put $5,000 in my IRA. Great. Maybe you paid $6,000 down on your mortgage. Awesome. You're going to do that anyways. Maybe you put a deck on a house, a rental property that you pay out of pocket $3,000 for, but it's only going to appreciate the value by $1,500. Great. At least you can know the numbers, right? So how much, if we calculate all those things together, what is our total reinvestment and what percentage does that equate to as our part of our income? Now, here's what doesn't include in the calculation. You cannot include car payments. Like, Justin, I have a car. I pay $1,000 a month. We actually had an individual who started working with us, and we're working diligently to help him with this. I was paying $25,000 a month. $25,000. Let me say it again. $25,000 a month in car payments. Yeah. That does not help with your annual income savings rate.
If we had learned anything from recent events, it would be the importance of having a personal financial plan to weather any crisis life throws at us. Heritage Investors helps small business owners to reach their financial goals with holistic wealth management services. Learn how by visiting heritageinvestor.com today.
$25,000 a month. That is crazy. If there was ever a time for placement of a commercial from one of our sponsors, Heritage Investors, that's it. Okay? This individual desperately needs him. We're actually benefiting him greatly by getting his life in order. You say, Justin, I don't have a $25,000 a month car payments. No, but you probably have $500, $600, $300, $1,000, whatever the number is. That doesn't count. It doesn't count because it's an appreciating asset. One exception. You may be someone like my dad who liked to invest in collector cars. You may be someone like a dear friend of mine who likes to invest in collector cars. Collector cars, you can often resell them for a greater value than you paid for them. Another one that doesn't count is boat payments. Most boat payments are depreciating assets. They're depreciating. Even though you're making principal payments, you pay $100,000 for a boat today, chances are you're not selling that boat in 10 years for $150,000. Chances are, now there are some exceptions. I realize this, and my boating friends would really quickly tell me the difference. But for the majority of people, it's just not a calculation we're going to include. And you're not going to include the payments you make toward your credit cards. Consumer debt adds no value other than a reduction of liability on your asset sheet. It doesn't create an asset that's going to appreciate in value. So by moving money to credit cards, you're not saving dollars. Yeah, you're saving future dollars through interest, but you're not actually saving dollars. There's a term that was coined called pay yourself first, and it was coined by George Samuel Clausen in the 1920s. He was an American entrepreneur who founded a successful publishing company in Denver, Colorado. Now, he's most famous for writing the book, The Richest Man in Babylon. The Richest Man in Babylon. In 1926, Clausen, if I can speak right, began to distribute pamphlets on financial success to banks, investment houses, and insurance companies, where he derived financial wisdom through a parable, which is now turned into the book, The Richest Man in Babylon. It's one of the books that I read every year because it talks about this concept that if we don't pay ourselves first, we're often just stuck in the mud. I was riding a four-wheeler here recently, and it got stuck. We ended up having to use a winch to pull it up the mountain. It was just spinning in the dirt. We couldn't, no matter how much effort we made, it would not go anywhere. And perhaps you feel that way today in your personal finances. Perhaps you feel in your business that no matter how you move, you're just not making the headway that you want to make. Both Robert Kiyosaki and Dave Ramsey utilize the concept, pay yourself first, which is why I love each of their teachings. Now, I've got to tell you, they each talk differently. They speak at things differently. And, you could have one camp versus the other, A versus B or B versus A. In fact, I did a video, one of our most popular videos on YouTube, where I did the epic battle between Robert Kiyosaki and Dave Ramsey and boiled down their teaching into this battle. And candidly, if you're in one camp or the other, it really doesn't matter. You're going to end up following either one of their instructions. You're going to be okay. But one of the heart of their instructions, they come to pay yourself first. So let's calculate your income savings rate. I don't know the amount of money you made last year. You do at this point. Maybe it was 100. Maybe it was $1 million. Maybe it was $10 million. Maybe it was $1,000. Whatever it was. How much did you save? Did you save 10%? 20%? 30%? I've walked through thousands of financial planning scenarios in my almost 20 years in the career. I can tell you without a doubt that the greater your income savings rate, the greater your net worth. I can tell you that without a doubt. Barring an inheritance, but without a doubt, the more money you save, the greater your net worth. Because what you're doing is you're investing in your future success, not your present. It's kind of like the way if we eat properly, we're going to be more healthy than if we don't. Same thing when it comes to savings. At a minimum, I believe that 20% of our income should go into income replacement assets. Notice what I said. 20% of our gross income should go into income replacement assets. Where do I come up from with that number? Inevitably, at some point in our life, we're going to have to live off our assets. There's fewer pension plans today, especially for my generation. So the amount of money that we amass in our income-producing assets, i.e. investment accounts, rental property, passive income businesses, etc., the greater that we amass there, that's what's going to provide us a supplement to whatever Social Security benefits we have here in America. Unknown at this point. So in order for us to replace the amount of income that we're used to living on, it takes roughly about 20% of the income, the gross income that we're making now to replace it, period. The closer you are to retirement, that number ends up being greater. We're ultimately trying to fill a bucket so that at some point we can turn a spigot on and let that income flow out of that bucket to provide our needs for some length of time. I'm seeing this trend that our generation has this fantasy, really, that we want to retire at age 50 and age 60. That's great. I hope you can. But you realize that you're having to replace your income for 40 years, 60 years or so, depending on when you retire. You see, the vast majority of Americans aren't saving enough to even replace their income when they retire. We're just not doing it. So here's where it gets complicated. I don't want you to think about your debt reduction as part of that 20%. If you're not at least saving 20% of your gross income, not including the amount of money you pay in principal to your mortgage, not including the amount of money you pay in principal to other types of debts, we're not talking about the debt reduction. If you're not saving at least 20% of your income, then chances are you're not going to be able to replace your income at some point in the future. Just a pretty broad brush. I get that, but that's a pretty well-established number. We can change this, friends. We can change this. We're going to further drive home this point in our next episode when we cover how to calculate the lifetime's earnings results Trust me, it will be depressing, but I think it'll drive the point home. Whenever I calculated my annual income savings rate and my lifetime results, my lifetime saving results, something clicked in my mind, and I then began realizing the importance of paying myself first. Friends, we don't have to be a statistic. We can manage our money well. Make 2021 the best year that you've ever had. Set a thing in motion which is going to drastically change your trajectory in your personal finances. I realize that life is hard. I do. But life is good. Man, it's a great new year. And life can be frustrating, but it doesn't have to be. We're going to continue to make our lives at least financially simple. Until next time, hey, y'all make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.